Hydrak, and I'm going to be your facilitator for the third annual investing seminar at the Wilson County Library in Texas. I'm going to give you a short rundown about my life. I've been doing this for the last 48 years, and we're going to start the seminar with a quick, short 30-second about my life. So with that, let's move to part one. Okay, here we are on the other side. Good morning again. Let me give you a brief story about the Wilson County. Wilson County was established in 1860. It was a combination of several different counties in the area, and eventually the county set the seat and the courthouse at the city of Floresville. So the city of Floresville is where the county office sit at. This is the place to be. Many years ago, I started doing a seminar at the event center for the city of Floresville, and then eventually I approached the library to do the same thing at the library, and since then we've been doing it at the Sanford Junior Public Library in the city of Floresville. They are located at 1103 4th Street, Floresville, and it's a system of one of the libraries in the Wilson County. They got several cities where the county has the library. With that, this is the place where we normally started. This is our third year with the county, and this year we're going to do it via online. So this is last year. Our second year annual, we have a little contest for the students and the participants on the class, and they do paper trading to get used to it and to familiarize themselves with how to invest and trade stocks. And the first place was Mr. David McKean with $20,000. Second place was Elaine Smith, and the third place was Buddy McLaughlin, the third contestants on it. So we do that every year, and this year we are going to do it online, but this year we won't be no prize because there's no way to monitor. So this is the newspaper produce a short article about the story and how we got into it, for how long I've been doing this. I've been doing this for over 48 years, investing and trading. And this is the winners. This is Mr. McKean here with his check. And the director of the library presented the check to him. This is the second winners. And the other one is this lady here is one of the members of the class. The third prize winner was not available for the photo shoot. I guess he was kind of shy. Stuff like that. So this is how it's going to be done. You know, the seminar we introduce the videos every week. This might take about 9 weeks. It's going to be very similar to what we have in class. It's only available through the internet only via the library channel. You have to call the library and to access a code in order to go to the class. And of course, if you have any question, go ahead and you send it to Floresville 2018@yahoo.com, and I'll be glad to answer the question for you. Do not call the library for questions since they're not familiar with the training and the course. They only allow the facility. We use the community room that they have to have the seminar, but this year, due to the virus, that don't happen. So you better be ready to be prepared to wake up the financial genius inside of you. You will learn about stocks, options, investing strategies, and so on as we go along. One thing about it, and I'm going to tell you one of the things that you need to know, and it's this one here. If you're not willing to change your way of thinking, you cannot do this. So you have to have an open mind and be willing to change your way of thinking. Otherwise, you're not going to make it. Take it from me. I've been doing it for 48 years. Now, one thing you need is discipline. When you embark on this, you have to have discipline. And you have to be willing to be trained. You want to develop new ideas and so on. Come in class, normally on the live class, you come late, is a sign that you're not interested on it. And I'm going to tell you that if you come late into the class, or if you are my employee and you come late, you don't want to last long working with me. The number two is clear vision. You have to be clairvoyant. You have to have a vision of what you're doing. Number three is obsessed. You have to all the time be excessively preoccupied with what you're doing. In other words, you have to love what you do. You don't want to do this because of the money. You got to do it because you like it. I like to do this. I'm not much interested in the money, but I love to do this kind of stuff to the point that I do it for free. I teach it at the library for free. I don't charge. I never had charge, and I don't plan to charge. You have to be fearless. What I mean is that you have to be bold, brave, and intrepid person. When you make a decision, don't change your mind in the middle of the game, because if you do, you're going to fail also. So you have to be, you decided this is what I'm going to do. I'm going to enter the trade. I'm going to buy this stock. Don't change your mind in the middle of the game. Also, you need to do your research in order to be sure that this is what you want to do. Number 5 is money. In the Latin word moneta, any medium of exchange. Money, it can be anything if you can get something for what you want, what you give or trade. Notice, and I want you to notice that money is the last requirement. If you don't have the first 4, money don't going to help you. I have seen many people lose $500,000. So it's obvious that they were not doing the right stuff. Money was not the problem. $500,000 is a lot of money. But the first 4 they did not have, or they was missing one of them. And therefore, money didn't help them any. So the last thing you need to worry is about money. What you need to worry is about having discipline, learn this, you master this, and then you'll be able to do like the other students that we just showed you here. So with that, we're going to move into a short introduction. You here is because you already subscribed, you already called the library, and you register, and now you can access our online seminar. So with that, let's see how we're going to continue now. Okay, the first things I'm going to show you is some background of what I have done. Back in 1987, I used to trade copper, oil, gold, silver. That was my kind of psychic deal, to be trading those things. So I used to write in a little piece of paper when did I bought it, what I did, and what I bought it, in July, how much I paid for, and so on. So I keep track of every month of what I have bought, at what price, and so on. You should do the same thing when you start doing trading. You should be aware of that. It's a matter of good records. Then here's some of the commodity from Prudential-based securities. Back then, I deal with Prudential. And you see here, I got some copper, gold, silver, platinum, Europe. And we did a lot of trading. We traded a little bit of money, profits and losses, and so on. And back then, we used to pay like $60 per trade going in and $60 coming out. So that was $120. Just imagine now that it's commission free. And some people lately, we have paid $5 whether you buy 1,000 shares or you buy 500 shares or you buy 10 shares. What's happening now is that, yes, you get commission free, but don't be fooled by that. What really happened is that the market maker now changed the price between ask and bet price. You'll find out about all these things later, but this is just briefing you of what's laying ahead for you, so you won't be surprised of it. So if we have an ask bet of $50 a share, and the bet price is $49.50, so that means they're making 50 cents a share. So you buy 1,000 shares, they're making $500. This is much better and profitable than before, where they only charge $5 or $60. So it's not free. The money is made now on the difference between what the market maker willing to pay when you sell and what he's willing to sell it to you when you buy. And we're going to discuss all those things during the course. So this is just a briefing on the course. And so it shows you that I've been around for a long time. This, like you can tell right here, this go back on, shit, I don't know. Forgot what month it was, but it was back in probably 1985, 87. But that's not important, just for you to see how those statements used to look like. Now, here's something that you need to know. And this is what I want you to learn this seminar. You need to know this. The educated trader get paid from most of the time, right? For most of the time, he get paid from who? He get paid by the non-education and no plan trader that he trades on emotion. You cannot trade on emotion. You cannot come in here, well, how about I don't make it? If you're thinking about losing your money before you go in, don't even go in, because you already got the wrong set of mind. So you have to change your habits of what you do. So the educated trader chart, actually what we're telling you is that for you to make any money, somebody else has to lose it. It's just that simple. Money don't disappear. So every time you buy shares, somebody take the opposite position on you. Always remember that. You buy, somebody's shorting it. And what they're saying is, the price is going to go up and down during the day, and what he bought, if it goes down, I'm going to make money. Even so, he don't sell, I just make it with somebody else. But this is how the market works. So right off from the beginning, this is something that you probably never thought about it. You figure, oh, I'm going to buy my stock, I do this, tomorrow I'm going to look, oh, it's going up, oh, how fancy it is, you're so happy. But that's not really the real world. The way it works is you buy and somebody is short. You also can short, and when the price go down, you make money. A lot of people think that you can only make money when the price goes up. That's not true. You can make money on either direction, whether it's go up or down. And we're going to show you on this seminar how it gets done and how you can practice on it and how you're going to do that. So this is part of the seminar. I'm just giving you a briefing of what's coming ahead, okay? It'll be very simple. There's no mystery. There's no trick. There's no high formula. You don't have to be a genius. All you need is some common sense. That's one thing that you really need, common sense. So always remember that for you to make any money, somebody else has to lose it, okay? Or it's not, somebody else going to lose it sooner or later. It all depends when you get out, and there are many trade, millions and millions of trade by the minute. So you'll be surprised. So when you might work, your stock going down, somebody's shorting it or making money, he sell it, somebody else, you don't even notice that this is going on the background of the business. So always remember, the educated trader like you, when you finish this seminar, you're going to be well educated in this. You're going to make your money from those that don't have no education, no plan, and they act on emotion. So you take advantage of those guys, okay? Now we go to the next one. Remember this one? It's here on purpose. I'm repeating it again. You have to do this, okay? You have to have discipline. The other guy, the non-educated one, he work on emotion, he don't have no discipline. So he don't have no discipline, he's gonna lose his money. Like the guy that I told you that lost $500,000. You have to have clear vision. He don't have no clear vision. He don't worry. He think, oh, well, Joe Blank told me that this stock was good to buy. Facebook, because somebody is using Facebook or whatever, and you just buy it. But you don't know in the background if, for any reason, Facebook is being checked by the government, they're going to be investigated, and it so happened that you're not aware of that, right? Because you don't worry about those things, right? You're not preoccupied, you're not obsessed about it, and all of a sudden your stock starts going down, then you worry about it, now you start playing on emotion, and you sell. And you say, man, I lost some money. Well, that's the way it is. So you can have no fear, So before you go in, you have to know that. So as you know, that's what I'm going to remind you. So here we go. First thing I'm going to tell you is this. This is the first part of lesson 1. Number 1, we see here an EKG. Can you read an EKG? I'm supposed that if you are in my seminar and you maybe are a doctor or a pathologist, you probably can, okay? Or you heard about it. If you never heard about it, an EKG is a test that they do on people like me that have heart problems, not from the stock market, but because wrong diet, and they attach all these wires on your body, and then by the electricity that is on our body, they get a signal of the beat of the heart. I cannot read this, okay? It's a chart, and we're going to deal with a lot of charts, but not about medical charts. This is a medical chart. You're going to learn about a stock market chart. You're going to learn how to read those charts so you can make money. You're going to take action based on those charts. You don't going to have no emotions. You're just going to do it by the book. If the indicators say no, don't do it. You remember that you probably saw on part of my introduction that I was a pilot, right? I'm not a pilot anymore. I'm too old to be flying. I leave the flying for somebody else. However, they have instrument flight ratings. And what it is that, and this is an example, is that they make you fly, they put a hood over your head, and you fly, you cannot see outside of the plane. And you have to go by those instruments, okay? You don't have no reference to the outside. You don't know what the horizon is or anything. And sometimes you get the feeling that the plane is falling and you pull on it because you don't trust, right? You don't trust those instruments. Well, the same thing here. You know how to read the charts, right? So you don't go by feeling. So this is for doctor, and you can tell the condition of the heart. So since we're not doctors and we're not going to study medicine, we need to read different kind of chart. This kind of chart. This is what we're going to read. We got to interpret what those little dots and those little bars mean. We're going to say what that line for. Don't worry about it for now, okay? You don't have to worry about it because we're going to take care of those things for you. We're going to show you that. We're going to show about volume. This is the date. This is the month, September, so every bar is a week, and every price is for a day, where the price was up and down. Is it red, or is it black? They have different colors. But green, on this case, is set up for green for days that the price went up, red for the day went down. However, you got to see that during the day, the price moved from one price to another. These indicators tell you the direction. You can tell right here. Well, we don't call the name of the indicator. You're going to learn there are many of them, but you'll be able to see here, for example, it's coming down. The black line is coming down, and what the price is doing is following the same thing. And then eventually this line starts going up, and guess what the price is doing? The price starts moving up. But then it kind of gets flat over here, and we ain't going nowhere. We got other indicators like the S&P 500. You're going to learn about that. The Russell 2000. Those are my favorite indicators. You can use whatever you want to when you learn this, but I feel very comfortable with it. I have made money with it, so I don't going to change. If you got a good deal going, why change it, right? So with that, let's move to the next one. So this is just what you expect to see and what you're going to learn. This is another form of charts, However, this compiled in one screen, 3, 6, 8, about 12 different charts. Each one have a purpose. This is the Dow Jones Industrial that you hear a lot about it. We look over here, we got about 2 months on this chart. And this is just for quickly get an overview of what's going on in the market. Okay, not for what you're going to trade, buy or sell. This is the Russell 2000, this is the NASDAQ. This is the Wilshire 5000. This is the CBO, Chicago Board of Exchange. And they track an index for the 10-year bond, the government bonds. You don't need to know all these things, but they are used as your tool. These are your tools. Just like a mechanic got 9/16 range, a half-inch range, a plumber got pipe wrenches and level, we got this. As a trader, this is our tools. Our tool is on a screen. It's not in a toolbox, but it's our, toolbox in the sky, in the internet. This is the VIX. The VIX behaves different than the Dow Jones Industrial. It uses an indicator. This is oil futures, how the price of the oil move up and down. This is the New York Exchange Advance, stuff like that. This is the term, how many shares how many companies went up today and how many companies went down today. That's what it tells you an index of how the market is behaving. If 500 companies went down and 2,000 went up and all that kind of stuff. To be a good trader, you have to have a general idea of this, but you don't going to be using this, but it kind of give you a glance how the market is behaving, especially if you expect that the market going to crash. Well, in 2008, I predicted in March before November came around that the market was going to crash, and it lost 50%. So it's good to know, so you take your money out and park it in a safe place like 10-year bond. It pays very little, but you don't lose any money, and it's guaranteed by the government. So you got to make sure of that. So let's move to the next one. The next one is kind of how those little charts that you saw and bought a while ago. So this is what we call a bar chart. It's because a long bar, and this is what they call candlestick chart, because they look like a candle. They got a little wick here, stuff like that. This is chart here, this little symbol here, is provided by AB Tech. AB Tech is a company that published some of this stuff, and we got to give them credit for them to make it a drawing for us, or for us to use it. We can use it with no problem. We're giving credit. This is not my drawing, and we don't get any copyrights on it. So to understand one of those bars, what I say is that in the market open, you're going to see this bar over here with a little stick out here, the price that it opened. When the market You see in the market open at 9:30 New York time, and let's say they open at $5, and it went down during the day. We don't know at what time, but during the day it went down to 3, and then it went up, and the high of the day, the high of the day, it went from 5 to 7, and then it closed at 6. So this is the closing price. So on the left-hand side, you got the open. At the bottom is the low of the day. At the top is the high of the day, the highest price of the day. And this is when the market ring the bell at 4 o'clock in New York time. Ring, 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 whatever. That's it. That's what we get, the close. On the other side, we got a candlestick. It's very similar, but it got double side bars. This is the open, and then this is the same thing. This is the low, this is the high, and the upper part of it tells you where it closed. So this is actually what that means. Those little bars, we're starting to see what those things mean. Okay, we were talking about candlesticks on a previous chart. So we're coming back to this chart to show you right quick here how to read this. So let's say, for example, is October the 12th. So the market opened right here in the morning, right where this little bar is. We enlarged the chart so make it easier for you to see how it works, okay? And it opened on this price. We don't know where the price is at, so let's look at it right quick over here, right? So it opened like at $270, and it reached at high at 280, so it went up $10 on that day. We can see right here, 280. So it opened this here, 270. It went as high as 280, but during the day, at one time, we went probably like at 268 or something like that, below 270, right around here, right about 268, I would say, about 1 bar. 268 was the low. It opened at 270. The high was 280 and closed right around here, about 278. 278 right here. So actually, between the open and the close is $8. But during the day, it went up as much as $10. And it also went down as low as $268. So this is what it tells you there. It's green because it went up. It went up. Okay? It's hollow. You don't see a solid one because what? It opened a higher day than the previous day. This is what is green. I don't have no solid color. So the market opened 9:30 in the morning. Boom, we got it here, 270. Maybe 20 minutes later went to 268, right? Then it went up at high at 280. And by 4 o'clock, this was the seller price, $278. Because it's open higher than the previous date is hollow. Now let's look at the next date. Now we go on the 13th. So here's October 13th, and the price opened exactly where it closed, 278. This is what is black. It's covered all green. It went higher, so it went to 260, 275, just about. This is the low, 275, and it went just as high as 279, but it went to 280, right? 279, and so it opened about 278, the same price that it closed a day before, to 278. It went as high at probably a couple of dollars, about 279. It went as low as 275, and a little bit over 279 or so, and this is where it's solid. Next day, guess what happened? Maybe it opened below or it opened down here, right? So it's a red day. It's not higher than the other days, just barely shy. So when it opened, it's open here, it went down this low, it got a little bit lower, and then went back up a little bit, but at the end of the day, it closed a little bit lower than the previous day, and that ends that, or it opened here, and this is actually where it closed. It closed way down here at 272. So since it's a red day, it opened just below or even with, and then went down, and it never recovered. It never went higher than previous day, so it probably opened at 278 unless, and then it went down all the way down to 272 or a little 271, and then went up and down, but at the end of it, it closed down here. Next day, it's a solid day too, where it went down red. It just didn't have a chance, so it's solid. So this is this is just a preview of how you read this stuff, okay? So we're gonna take it back to what it is before, and this is about the volume, how many shares it trade. 25 million shares shows in here, just on one day. Over here, a little over 25 million. And over here, on this day, you can tell it was the 26. It went up at high at close to 72 million shares, just on one stock. So we're going to leave it here, and we're going to continue with our instructions, but just to give you an idea of how this thing works. Okay, so now you have an idea of how this actually, what this means. Open, when the high of the day, the low of the day, and where it closed. And that's what that symbol means. So you notice that this is a chart similar to what the cardiogram does, EKG, electrocardiogram, but we don't know how to read that one. We don't know how to read this one, so you can make some money. Now let's go to the next slide, and what we got here is candlestick was created in Japan. This is a little background on how it created. It was used, over a couple of thousand years ago, who knows how far back. There was a Chinese rice trader that used this candlestick because the isolation policy, it was not until 1852, those years in 1852, the United States traders was using the bar chart. They were not aware of this type of candlestick, Japanese candlestick. In the United States, they use the bar, but it got similarity the same. It open, low, high, and close. It was not until late 1985 or 80s that this candlestick chart became very popular in the United States. And from then on, this is what most traders use. Very few use the bar chart anymore. But I thought I'd give you a little rundown on why they do the same thing, but this is more, it got more information than this one. And whether you're using it on trading for monthly trade chart, weekly chart, or day chart by the minute, they behave just the same. Let's look here. So here's the Western bar chart, and it gives you a little better explanation on how to read it. The high was 12, the low was 5, the open was 5, the low was 3, and it closed at 10, and the high was 12. This is how I read. Here the same thing, but now we have it in a candlestick. It opened at 5, the high was 12, it closed at 10, and the low was 3 way down in here. There are other factors involved here that we're going to talk about later, but for you see the difference between the Western bar chart and the Japanese candlestick. But it tells you the same thing. You can see the price going up, it's trending up, and it goes down. Over here, it's very obvious that this thing probably open here and end up down here lower or open. The open is, it don't even show, so it might have open over here, right? Or the same price. You open here, and it never have a chance of low. It closed over here. So this was the open, that was the high, but eventually it closed way low than the day before. Over here, we got the same thing, you know, and closed down here. So it might have opened lower than the previous day, and it make a run for, but it never closed higher than the previous day. So the close is down here, and so on. So with that, let's see right quick what we find on the next slide. Okay, we're going to get here, and this is what I talked earlier about market makers. This gentleman here worked for at the American Stock Exchange. The two kids you see over here, they're summertime off the school. They're children from these traders over here, and they come in and help their parents, and they get training. They actually get training, or what my dad does for work, you know, stuff like that. Now, let me explain you about the market maker. Any market maker like him, he's in charge of the post, and the post comes into the picture. They call it the post because back in the 1800s, the trading was done on the street. It was all kind of rackets go around selling stuff that they did not even exist, stuff like that. So they said, but the light post, you know, on Wall Street, and people go and buy, give money, and all kind of rackets went around. Eventually, the government intervened, and it get a little bit more authorized, but the name remained, the post. Now the post, that means that he might represent 25 or 30 company, you know. So any trade on the exchange that relate to the company that he represent, it has to go through him. Somebody else cannot do it. So there are many on the floor, many like him, many posts, but everybody is specialized on certain companies. The way it works is this way. You take, for example, you know, Bank of America, JP Morgan, stuff like that, different bank, you know, credit unions or whatever. You as a work person, you have some savings and you put them on the bank. The bank give you a quarter of 1% a year. But the bank can lend money, and you're going to learn about how the banking system work. You know, this is a video on this first part of this lesson. This is part 1. There's part 2 on lesson 1, and it could be probably part 3 before we get moved to lesson 2. But you need to know this. Be certain and rest assured you need to know this. This is not a fluff to build. You need to know this because you need to learn how the system works, and even more, you have to change your way of thinking. Believe me, you have to change your way of thinking if you're going to make it on this business. If you don't, you already failed. If you're not willing to change, you already failed. Always remember that. I'm telling you by experience, I've been doing this for 48 years. So I can guarantee you that if you don't learn this, if you don't follow this, you say, well, I don't want to know that. I just want to know about the stock market. I don't need to know about the government. You do, because they determine how you're going to eat tomorrow. It's just that simple. They raise the interest rate, and all of a sudden you cannot buy a car because the interest rate is too high. You cannot buy a home. Your credit card stick you 28% interest on your credit card, so you're paying 100% interest in 5 years or better on a credit card. So credit card is the biggest money maker for the banks. But people cannot do away with credit card. So they got you hooked. Okay? So here's what happened. The bank turns around and take this and give them, let's say, a big major bank to say, okay, Mr. Market Maker, we're going to give you $500 million this year for you to do trading. So in other words, he's working with somebody else's money. The money that me, you deposit at the bank, your retirement account, or whatever that money is, this guy gets it. So, and he probably made $3 or $4 million a year out of this. So he got the post, he bought a seat on the exchange, he probably cost him $500,000 to be on that position and the knowledge that he got. And then he hired this guy here to execute the trade. So everything is on Word. There's no signing paper here, And what we're going to see a few minutes of the market when it's trading, and you turn around and the market moved on, and it's about time to close, and it became very hectic about it. It's exciting for many people, but let's look at it, and so you get an idea of what happened. So at the end of the year, the bank that he representing him or financing him comes in, hey, we'll give you $500 million, you make X amount of dollars, he get X millions of dollars for that, and you're going to get 0.25% of your money. They're using your money. They're using your money from your retirements and from your savings account to make all this money, and you get the crumbs. Well, it's about time that we change that. It's about time that we start doing what they do with our own money, because it's going to be our own destiny. And this is what I want you to learn before you make your first trade. Okay? So let's see how this thing works out.
Yeah, the last half hour in the trading floor is really busy. It's really, sometimes you got to really concentrate, especially when the market starts to make a decent move like it is right now. There's nothing really out there that shows why it should have sold off. 30% of what it was up on the day, but it's taking a good hit here.
4,900 shares and a half ATS.
Something caused it to sell off here in the last few minutes.
10 for 24 and 51 sold. 49 more trades at 51. 5,000 trades at 54. 2,500 shares.
Sounds like HOM's picking up a lot more.
I'm out. No. What's he doing? He needs to know what he's doing. You bought 4,800 shares and a half DK. You bought 4,000 shares and a half ATS.
You leave 15,000?
All right, listen, I'm going after you. Listen, you bought 4,400 shares and a half book.
He's almost done. He leaves nothing. Performance.
600,000, 57 sold. 1,000 trades at 56. 54, 5,000.
90 bit away, buddy. 90 bit away.
54 for 3,000 shares, 2,059.
The most challenging thing is having to make split-second decisions. You can't really think that fast, even though you believe you can. You can't. You're going on instinct. You're going on reaction. And that's the toughest part of the job, is having to stay focused through that.
2,057. What was the light after that?
Just going to step up.
Okay. 2,000 trades at 57. ATS 61 for 2,002 taken. 2,000 trades 62. At 65. 5,065. 1,5. 5,009. At 41. 5 seconds. 1,5. 5,009.
Customer's got no room?
No, that's it. 63 for 4,000 to 4 taken. 4,000 trade 64. Selling about. 5 more trade 64.
Not enough to get it there. 4,000 or 5,000 shares, maybe?
6,000 trades at 63. 2,5. 5 up.
Nice. Close them up. Amazing, a lot of stress. I can't tell you how many times I've had what I thought were chest pains, numbness in the arm, and sweaty forehead and sweaty palms, dizziness. It's happened at least a half a dozen times. It's the most exciting job you could ever have. If you don't love this place, don't work here. You have to love it. You have to be passionate about it. You have to really care about it. It's a unique person that's able to sustain a career down here. Yeah, the last half hour in the trading floor is really busy. It's really...
So there you have it. It's exciting, and if you don't love it, don't work here. Yeah, very interesting, right? You have to like it to do this kind of work. You notice that once the bell ring, any order that stayed behind, that could not be filled, that they had to stop trading, that get left over for the following day. And then the market opened in other parts of the world much earlier than ours, and all those orders also pile up on the top of it because United States is the largest market for this trading stocks and all that stuff. There are other countries out there, but nothing is bigger than the one in the USA. So let's see what we got for the next. Okay, this is how our Federal Reserve works, and the understanding of how money flows around and how money is created. After this video, we're going to see why we agree to accept the way things are without questioning. We just go ahead and do it. And this is one thing that you need to know, okay? You need to know how our monetary system works because it affects your life. It determines whether you can buy a home or not buy a home. It determines if you're going to have money to invest. All those things are affected by somebody else's decision. But since you were born into the system, you don't realize in it that that's what it is. And I'm here to tell you how the cow eat the cabbage, okay? So I want you to see this very carefully because the way the money is created is not what you think. They tell you the government's printing money, the government printing this. That's not really true. Don't believe that stuff. Money is created locally, wherever you live. Every time that you buy a car, every time that you buy a home, every time you do anything that is finance, that's money creation. So you go to the bank and borrow money to buy a car, you just created money in the local economy. And it counts in the monetary system. It's not Washington printing it. When the government lend money to the city, when the government lend money through FHA or VA loans to buy a house, this is how money get created. You keep on spending and spending. Then the government, to pay the debt, right, it had to tax you. Was created the central bank system and IRS, Internal Revenue Service. And the reason you start getting taxed for working is so they can pay the interest on what the government borrow from the Federal Reserve. Now, one thing I want you to know, the Federal Reserve is a private corporation. The name makes it sound like it is part of you, okay? Government. It's not. It's a private corporation running the money affair for the United States government. The government goes through the Treasury Department, and you're going to see politicians want to spend money, just like your city government do, and say, oh, well, we're going to build a convention center, so we're going to sell some bonds. Selling bonds, or the governments, your city say, we're going to make, at your school district, we're going to make more school for better children education, blah, 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 blah. So it put them on an election date or whatever. You go and vote if you want to do that. They say, oh, this is for education, and people fall for that. Oh, wow. Man, my children go to more education. When you vote for those things, what you're saying is, yes, go ahead and spend the money and go ahead and tax me to pay for. That's actually what you're saying. And normally, when we use education for the children, we want to do the best for our children. But in reality, if you look back, the educational system is already broken because children come out of school that they cannot even do, a lot of them, multiplication tables. And I'm one of them. I never learned my multiplication table. I figure I don't need them. But they can't even give change on the store either. To the point that McDonald's had to put menu pictures on the keyboard so the kid would not give the wrong change. So they programmed the cash register with a bunch of pictures and $1, $20, $5. So you press that button for he get and telling how much to give change back. It's very sad, but McDonald's had to do that with the National Cash Register Corporation because they were losing money because the kids could not give change. Very sad. But anyway, let's look at it, how the federal system worked. And remember, the Federal Reserve Bank, it don't have nothing to do with the U.S. government. Okay, so let's get with it and learn something today.
They say that money doesn't grow on trees, but the truth is that the modern banking system creates currency far faster than trees can grow. Most people don't have a clue how currency is created. Economists and bankers make it sound so complex that people think they can't understand it. But I'm going to strip our monetary system down to its essence so that you can see the scam behind the curtain and just how it affects you. Every modern society creates currency in pretty much the same way. But since the US dollar is the majority of the world's currency, I'm going to use the United States as our example. It all starts when some politician says, "Vote for me and I'll make sure the government provides you more free stuff than my opponent will." But there's no such thing as a free lunch. So to provide that supposedly free stuff, the politicians vote for the country to spend more than its income. This is called deficit spending. To pay for that deficit spending, the Treasury borrows currency by issuing a bond. So what's a bond? If you think about it, a bond is really nothing but a glorified IOU. It's a pretty piece of paper with numbers printed on it that says, "Loan me $1 trillion today, and I promise over a 10-year period I'm going to pay you back that $1 trillion plus interest." But what you need to understand is that Treasury bonds are our national debt. These glorified IOUs are to be paid back by you and I and our descendants through future taxation. Therefore, when the government issues a bond, it steals prosperity out of the future so that it can spend it today. The Treasury then holds a bond auction, and the world's largest banks show up and compete to buy part of our national debt and make a profit on it by earning interest. You'll notice that as we move through this process, the big banks are there, taking a cut every step of the way. This isn't by chance, as you'll see shortly. Then, through a shell game called open market operations, the banks get to sell some of those bonds to the Federal Reserve at a profit. To pay for the bonds, the Federal Reserve opens up its big old checkbook and writes bad, bogus, counterfeit checks that should bounce because they're drawn on an account that always has a zero balance. There isn't one penny in there. To quote from the Boston Federal Reserve, "When you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money." The Fed then hands those checks to the banks, and at this point, currency springs into existence. The banks then take that currency and buy more bonds at the next Treasury auction. But what is a check? A check is also an IOU. When you write a check, you're making a note that says, "Here's my IOU for cash. All you have to do is go to the bank and pick it up." Now, it's very, very important that you understand this process because we're going to come back later and show you the devastating effect this has on you. The Treasury issues IOUs, bonds. The banks then buy those IOUs with currency. The Federal Reserve then writes IOUs, checks, and hands them to the banks in exchange for the Treasury's IOUs, the bonds. And currency is created. So what's really happening is the Federal Reserve and the Treasury are just swapping IOUs, using the banks as middlemen, and abracadabra, presto, currency magically springs into existence. This process repeats and repeats over and over again, enriching the banks and indebting the public by raising the national debt. The end result is that there's a buildup of bonds at the Federal Reserve and currency at the Treasury. This process is also where all paper currency comes from. The Federal Reserve and the government mistakenly call it base money because they didn't watch episode 1 of this series and they don't know the difference between money and currency. But I will correctly refer to it as base currency because it is not money. It is currency, and as we've learned, there is a big difference. Money has to be a store of value and maintain its purchasing power over long periods of time. We learned in episode 1 that earlier in our history, our paper currency was just a claim check. It was a representation for real money of intrinsic value, the gold and silver that was held on deposit at the Treasury. You could walk into any bank and slap your currency, like say a $20 bill, on the counter and redeem it for real money, a $20 gold piece. But now, this base currency that's piling up back here is really nothing but a receipt or a claim check on an IOU, that bond. So it's really nothing but a supply of numbers. The Treasury then deposits the newly created currency into the various branches of the government, and the politicians say, "Hey, thanks for that." And the government does some deficit spending on public works, social programs, and war. The government employees, contractors, and soldiers then deposit their pay in the banks. Now, this may come as a shock to you, but when you deposit your currency with the bank, you're not actually depositing it into an account to be safely held in trust for you. Instead, you're actually loaning the bank your currency, and within certain legal limits, they can do with it pretty much anything they please. This includes gambling in the stock market and loaning it out, at a profit, of course. Now this is where the machine of currency creation really gets cranking, because this is where something called fractional reserve lending comes into play. Fractional reserve lending is exactly what it says. The banks are allowed to reserve only a fraction of your deposit and loan the rest out. Although reserve ratios may vary, I'm going to use a 10% reserve ratio as our example. If you deposit $100 in your account, the bank can legally take $90 of it and loan it out without telling you. The bank must hold $10 of your deposit in reserve just in case you want some of it. These reserves are called vault cash. But why does your bank account still say you have $100 if the bank has stolen $90 of it? Because the bank left IOUs it created, called bank credit, in its place. Now I know this sounds crazy, but here it is in black and white from the Fed. Commercial banks create checkbook money when they grant a loan simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU. These are nothing but numbers that the banks type into their computers. And even though these bank credit IOU numbers are very different from base currency numbers, because they only exist in computers, they are still currency. So now there is $190 in existence. Now, the reason people take out loans from the banks is to buy something. They're going to buy a house or a car or something like that. So the borrower takes the $90 that the bank loaned to him from your account, and he pays the seller of the item. But then the seller deposits that currency into his account, and his bank loans out 90% of that and leaves bank credit numbers in its place. So now there's $271 in existence. This process repeats and repeats until under a 10% reserve ratio, an initial deposit of just $100 can create up to $1,000 of bank credit, all backed by $100 of vault cash, just 10%. But as I said, reserve ratios vary wildly. On some deposits, it's 10%, on others, it's 3%, and on some forms of deposits, reserve requirements are 0. The result is that the expansion of the currency supply by the banks is far greater than even this example would lead you to believe. So once again, when currency is deposited in the banks get to lend it out, and then it gets redeposited and relent, redeposited and relent, redeposited and relent over and over again, creating bank credit all the way. This is where the vast majority of our currency supply comes from. In fact, 92 to 96% of all currency in existence is created not by the government, but here in the banking system. Now, massive amounts of currency spewing into society may at first sound like a fun idea. That is, until you remember one of the most important hidden secrets of money from episode 1, that the prices of everyday goods and services act as a sponge on an expanding currency supply. The more currency we have, the more prices rise. This is where inflation comes from. The true definition of inflation is an expansion of the currency supply. Rising prices are merely the symptom. So our entire currency supply is nothing but a couple of bucks whipped up in this hocus-pocus scam where the Treasury and the Federal Reserve swap glorified IOUs, and a bunch of numbers that the banks just type into their computers. That's it. That's our entire currency supply. It's nothing but a supply of numbers. Some of them printed, most of them typed, and there is nothing else. But if you thought that was crazy, get ready to enter the twilight zone of modern economics. We work for some of that currency supply. True wealth is your time, but we trade away moments of our lives, hour by hour, day by day, and year by year, for numbers that somebody printed on pieces of paper or just typed into a computer. Now those numbers represent our blood, sweat, tears, labor, ideas, and talent. We are what gives the currency its value. But here comes the really cruel joke. We work hard so that we can save some of that currency, so that we can pay the tax collector. In the United States, it's known as the IRS. They then turn it over to the Treasury so that the Treasury can pay the principal plus interest on that bond that the Federal Reserve bought with a check drawn on an account that has nothing in it. Now let's ceiling. It's all based on a huge paradox. There was interest due on that bond, and there was interest due on every one of those loans that the banks made. That means that there is interest due on every dollar in existence. Let me ask you something. If you borrow the very first dollar into existence, and that's the only dollar that exists on the planet, but you promise to pay it back plus another dollar's worth of interest, where do you get the second dollar to pay the interest? The answer is that you have to borrow that one into existence and promise to pay it back with interest as well. So now there are $2 in existence, but you owe $4, and so on and so on. The result is there's never enough currency to pay the debt. There is always more debt in the system than there is currency in existence to pay the debt. Therefore, the whole system is impossible. It is finite. It will come to an end one day. What would happen if the government stopped borrowing to do deficit spending? Are the payments on those treasury bonds going to stop? What would happen if the public stopped borrowing and going deeper into debt? Are your house and car payments going to stop? No. There is a payment due every month on the principal plus the interest on every dollar in existence, and those payments do not stop. If we stop borrowing, then no new currency is created to replace the currency that we used to make those payments. Whether you're making a payment on a loan or paying tax to make a payment on a bond, the portion of the payment that goes to pay off the principal extinguishes that portion of the debt. But the debt also extinguishes the currency. Currency and debt are like matter and antimatter. When they meet, they annihilate each other. If we just pay off the principal only on all the loans and bonds that exist, the entire currency supply just vanishes. So if we don't go deeper into debt every year, look what happens. The whole thing goes into a deflationary collapse under the weight of those payments. Politicians and pundits alike talk about balancing the budget, paying down the debt, and living within our means. They don't understand that that is deflationary. It is impossible to do under our current monetary system without collapsing the whole economy. This is why any talk of a debt ceiling is not only ridiculous, it's delusional. The system is designed to require ever-increasing levels of debt just to continue. And that's why politicians will always kick the can down the road and raise this so-called debt ceiling over and over again until the whole system finally collapses under its own weight. In other words, they don't want it to collapse on their watch. The Founding Fathers of the United States knew the dangers of central banking and fought to free themselves from this very thing. The Revolutionary War started out as a tax revolt, but now we must pay tax just to have a monetary system. Having just suffered through the hyperinflation of the continental dollar, which was printed into oblivion to finance the Revolutionary War, they understood the dangers of fiat currency and debt-based monetary systems. So to protect future generations from institutional theft and out-of-control government, they wrote into the Constitution that only gold and silver can be money for the simple fact that you can't print them. Our current system is not only unconstitutional, but it robs us of the liberty and prosperity our forefathers fought and died for. We are all feeling the effects of ignoring the Constitution right now. By forcing more currency into circulation, our purchasing power is diluted. Inflation is a slow and insidious stealth tax that is simply the result of this debt-based monetary system. This system empowers and benefits those who create the currency and receive it first, as they get to spend it into circulation before it has an effect on the economy. They're stealing purchasing power from you and transferring it to the banks and the government every hour of every day because of this false monetary system. And it's not like the people at the top don't know this. To quote the Federal Reserve, the decrease in purchasing power incurred by the holders of money due to inflation imparts gains to the issuers of money. This is a fraud. It is a pyramid scheme, it is a Ponzi scheme, it's a scam, and it's a lie. Our entire monetary system is nothing but a form of legalized theft. But here's the biggest con job of them all. The Federal Reserve is not federal, it has stockholders. There is no federal agency that has stockholders. What's a stockholder? A share of stock represents a percentage of ownership in a corporation. So the stockholders are the owners of that corporation. Therefore, the Federal Reserve is a private corporation with owners. And you can see it for yourself if you go to the Federal Reserve's website, and it will say, the stockholders receive an annual dividend of 6%. Now we know that the stock in the Federal Reserve was originally issued to the largest banks in the United States. But because of mergers and acquisitions through the years, you can't actually trace who owns the stock in the Federal Reserve. That's a very closely guarded secret. My guess would be that the owners are those primary dealers, the banks that get to make a profit by selling part of our national debt, those bonds, to the Federal Reserve, who buys them with a check from nothing. Then we pay tax to pay the principal and the interest on those bonds so that the Federal Reserve can pay the banks a 6% dividend. Don't be alarmed if you don't quite comprehend the deception of this system at first glance. Very few people do. It is purposely complex. The economist John Maynard Keynes once wrote, "By this means, government may secretly and unobserved confiscate the wealth of the people, and not one man in a million will detect the theft." I believe that presented correctly, anyone can understand this system, regardless of how complex it is. So let's do a recap and break it down even more. The way the system works is that, step 1, the government creates glorified IOUs. These bonds increase our national debt and put the public on the hook to pay it back. Step 2, IOUs are swapped to create currency. The Treasury sells the bonds to the banks. The banks then turn around and sell our national debt at a profit to the Federal Reserve, which they probably own. The Federal Reserve then opens its checkbook that doesn't have a penny in it and buys those IOUs with IOUs that it writes, checks, on a checking account that has a zero balance. Then they give those checks to the banks and currency just springs into existence, and then the whole process repeats. This results in a buildup of bonds at the Federal Reserve and currency at the Treasury, which is really just a supply of numbers. The Treasury then deposits the numbers in the various branches of the government, and we get to step 3. The government spends the numbers on promises, public works, social programs, and war. Then the government employees, contractors, and soldiers deposit their pay into the banks. And we get to step 4, where the banks multiply the numbers by magically inventing more IOUs through fractional reserve lending, where they steal a portion of everyone's deposit and lend it out. That currency gets redeposited, and then a portion is stolen again. And the process repeats over and over, magnifying the currency supply exponentially. Then we work for some of those numbers, which brings us to step 5, where our numbers are taxed. We pay tax to the IRS, who then turns our numbers over to the Treasury, so the Treasury can pay the principal plus the interest on bonds that were purchased by the Federal Reserve with a check from nothing. Then we get to step 6, the debt ceiling delusion. The system is designed to require ever-increasing levels of debt and will eventually collapse under its own weight because politicians always kick the can down the road. They don't want it to collapse on their watch. And finally, step 7, the secret owners take their cut. The world's largest banks own the Federal Reserve. Those banks make a profit selling our national debt to the Fed. They make a profit when the Fed pays them interest on the reserves held at the Fed, and the Fed pays them a 6% dividend on their ownership of the Fed. This system is fundamentally evil. It funnels wealth from the working population to the government and the banking sector. It is the cause of the artificial booms and busts of modern economies, and it causes great disparity of wealth between the rich and the working class. And it is only possible because we no longer use real money, we use currency. But worst of all, it is a form of enslavement. Bond is the root word of bondage. Whenever a government issues a bond, it is a promise to make us pay tax in the future. Nobody asked you if you wanted to pay tax today for the prosperity we all enjoyed in the last century. Nobody is asking our children if they want to work hard in the future to pay for the prosperity we're enjoying now. George Washington once wrote to James Madison, "No generation has the right to contract debts greater than can be paid off during the course of its own existence." By stealing prosperity from tomorrow so we can spend it today, we enslave ourselves and future generations. Now this all sounds pretty bad, but there is great hope, for you are the greatest threat to this false monetary system. This system relies on the public being ignorant of its workings. Please share this knowledge with everyone you know, because an informed public that fully understands the system can build a better future for generations to come.